Welcome to my channel. I'm the cover call guy, and my goal is to create $120,000 per year passive income portfolio, right? Using only cover call ETFs. Right now, my portfolio yields about $72,000 a year, about $6,000 a month, about $1,400 a week, and almost $200 per day. Legal disclaimer before we start this video: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. So please, please, please always do your own research and consult a licensed professional before making any financial decisions. Remember, I am just some random idiot you found online, and I could be completely wrong. Now, with that out the way, this topic was actually inspired by you guys because a lot of you guys love the ranking and the high yield, and so I was like, you know what? I'm gonna do all of the Qs. And for those who are new, Qs are just when I say Qs, it just means related to tech, right? Anything that relate to like the tech stock or tech ETF, it typically has a Q to them, hence QQQ. So this is going to be the 2025 high yield year to date tech power rankings that I've kind of put together. I think this list is correct. It'll be 15 of them. So before we get started, the late 2025 income ETF market has split into two groups, which is my opinion. Institutional grade premium strategies focused on tax efficiency and NAV preservations, and the other half is the highly aggressive volatility harvesting products using synthetic leverage and a heavy option writing. All right, the bifurcation, pick your side, right? Pick your poison. All right, are you going to be the institutional core premium? The yields are typically going to be about 8 to 14%. This means you prioritize NAV preservation and tax efficiency, right? You're investing with the big boys, which is Neos, Goldman, and BlackRock. Your goal is sustainable, long-term compounding. Or are you gonna go with speculative volatility harvesters? The yields are typically 50 to 100% plus. That means you are going to be most likely investing in synthetic leverage and aggressive option writing. You're chasing weekly payouts from funds like HOOW and NVII. Your risk, massive rock, right? Return of capital dependency. All right, don't give me too much heat for this. I've made this video in the early mornings to noon. I am just putting it now at around almost 4 p.m. Eastern time. I've been trying to collect the list. When I was making this, I checked the market once, and the market was pumping. I haven't checked it since. I've checked the market maybe 1 or 2 times a day because, again, I'm holding long term. It doesn't really bother me unless the news pop up on my phone saying the market is crashing. Then I'll use some dry powder and buy the dip. Otherwise, I don't really care, right? So, the numbers, the percentages might be off a little bit. I put these numbers early morning, and the market, I checked around morning, and the market did pump. I don't know about now. But anyways, the top spot, number one spot, is HOOW. Total return at 110%. The price plus almost 18%. You guys can pause the video and see. But I'm just gonna go through it. I'm gonna do a speed run, right? Second place NVII, third place TSII, fourth place CHPY, CHPY, fifth place BLOX, fifth place, sixth place GPIQ. Some has price increases by that much, and then price is volatile because I saw blocks just shoot up. I was like, all right, if I put the price here, I know you guys are gonna give me heat and be like, oh no, it's much more. I was like, okay, you know what? What's the best way to just kind of be the middleman, the middle ground here? And I just put volatile, and then here I put yield because for stocks, ETF and or stocks like GPIQ taking sixth place, I put yield because yield is the primary way they deliver value, which is kind of the way it's highlighted in their perspective, right? Their price appreciation is secondary versus a ETF or stock like CHPY, HOOW, NVII, TSII. Their price appreciation is so extreme that it is more important. That is the more important metric to show, even though their yield is also incredibly high. So, you know, it's kind of the way I'm trying to present it to you guys so you guys can kind of understand it. So that's a massive difference between a core premium fund and a speculative harvester, in my opinion. Okay, let me just say that a little bit louder. In my opinion. Whew, I'm gonna get so much heat for that. Anyways, 7th spot is QDVO, 8th spot is KQQQ, 9th spot is MAGY, 10th spot is GPIX, 11th spot is DRKY, Darky, I don't know. And then last time I checked, the price was rising, but I could be wrong. At the time of this video, it could have shot back down. Again, I did not check since early morning. 12th place is TDAQ, TDAQ. 13th place is QQQI. 14th place is BALI. 15th place is SPYI. So this is the top 15 tech power ranking year to date, and it's coming to the year is coming to a close. So for the most part, I think this is going to be accurate unless the market takes an absolute dump or the market just do a massive bull run and the 16th, 17th, 18th place just completely changes the rankings here. For the most part, I think this is going to be the top 15 for the next 2 weeks, and then the new year begins. So do you guys think this is going to go into the New Year's? This is the top 15. You think is going to stay the same tech wise? For the most part, I think these are pretty solid. Well, actually, the top 4 is going to be the most volatile because they depend on that bull run. So BLOX is kind of like the crypto, right? Crypto tech. I mean, if you guys consider crypto tech, I do. Maybe I'm completely wrong on that, but I think that they're tech. Yeah, for the most part, I think obviously from 6 all the way to 15 are gonna most likely hold their place. Yeah. Let me know what you guys think about this power ranking. If you agree or disagree. All right, number 1, let's talk about HOW, Round Hill Hood, right? You are buying the leader, right? What you own, synthetic 1.2x long Robin Hood weekly calls. Why you like it? I'm guessing the massive year-to-date total return at plus 100%, right? Driven by Hood's explosive volatility. Your risk here is capped upside with magnified downside. If Hood falls 10%, you lose 12% NAV instantly. The red flag for you, payout dropped about 33% recently. So don't rely on this for rent, right? So this is more of going get your pay, go out, enjoy your life, splurge a little bit, reinvest. But this is pretty much very, very dependent on Hood just shooting up. Number 2 and 3, right? TSII from Rex Tesla. Right? You are buying. Wait, why is it 2 and 3? Did I get that mixed up? Well, it is 3. Anyways, I should have number 2 somewhere. All right. Number 3, TSII, Rex Tesla Income. You're buying the yield monster. What do you own? You own 1.05x to 1.5x long Tesla plus cover calls. Your yield is a massive 72%, but you are entirely dependent on Elon's volatility, right? One X post and you are screwed. Performance, positive plus 41.2%. Price return, about 80%. Total return, reality, you are receiving huge payout, but they are offering 100% return of capital. So something to think about. All right, number 4. This is number 4 when that should be number 2? My math is completely off. Maybe this is slide 4. Yeah, this could be slide 4. That's why I'm putting it. Let's see. Brex NVDA income. You are buying the AI trade, right? What do you own? 1.25x leverage NVIDIA. Your yield is a staggering 107% annualized. I don't know how long they're going to be able to keep that up. Another red flag, right? Performance plus 57.6% price return since inception. Total return is over 100%. Sustainability, like TSII, you're relying on destructive rock to get paid if the stock goes flat. So I will talk about the top 4 or 5 that I've mentioned earlier at the end. All right, no, oh, okay, so I do have it. All right, number 2. Wait, is this number 2? No. What am I doing here? Anyways, you guys have that list. I don't know how I messed up these numbers. Maybe I just reorganized the slide and I totally messed that up. Whoa. All right, Chippy from Yield Max semis. You are buying sector volatility. What do you own? You own a basket of 15 to 30 semi stocks, right? NVIDIA, AMD, AVGO. Your return is plus 63.15% total return. Amazing. You got an elite total return with price appreciation. The catch, your recent distribution were at 99.43% return on capital. The strategy failed to cover the payout, so they gave you your money back. My verdict, you are kind of holding a melting ice cube masked by a bull market. So once that musical chair stops, a lot of things can happen with these extremely ultra high yield payers. So just be careful, guys. I know I get a lot of heat from Chippy by saying this, but just be careful. I'm saying it because I don't want you to lose money. I honestly believe that. I don't want any of you guys to lose money. It actually hurts me when you put comments on like that. Man, I got burned. I learned my lesson. It makes me feel sad because I was like, man, because I've been in that position, right? I tell myself like I won't, I will never do it again, and you know these are my principles. So just be careful, guys. The total return looks really good, and if you made your money, learn to keep all of it, right? Learn to don't just funnel back into it, and that's called FOMO. You're like, oh man, this is gonna keep going up and up and up and up. Just be aware if it doesn't keep going up with the bull market, when the musical chairs slow down, because eventually it will slow down. It might be another 3, 4, 5 months, but it eventually will, right? We can't just shoot up with all these valuations. It has the profit, the revenue has to match. All right, just ignoring the numbers. BLOX from Nicholas Crypto. You are buying crypto income. As you guys know, if you are new, I do have this on my watch list. I do want another crypto in my portfolio. On top of that, this is a weekly payer. What do you own? You own Bitcoin and ETH ETF plus crypto equities such as Coinbase and MSTR. Your return up all time is about 42.67 total return. Amazing, right? However, the reality check I think is while the total return is positive, the share price is about $19-20 right now. Is below inception at 25. I don't think it was 25. I think inception was around $20. Was it 25? Anyway, something made me put 25, but I think it's around $20. I think all-time high was $25 is what I meant. Indicating a significant capital being returned to you as yield. So this one I am a little bit worried. The only crypto ETF I own right now is BTCI from Neos. I love crypto, but when I say crypto, I mainly mean Bitcoin. I just want to do Bitcoin, but a little diversity doesn't help with ETH, right? So this one is still on my watch list. I still want to see how it actually performs, and I'm gonna give it some time. I don't really care about getting in and I was serious about FOMO. I don't really care. I'm just gonna go ahead and do my thing and wait. All right, thematics and the guru strategies. And by guru, I mean DRKY, right? So when you're investing in DRKY, right, you follow Mr. Stanley's, pretty much his portfolio in his investments. So DRKY, the status here is price is rising at $22, positive momentum. MAGY is the thematic strategies along with KQQQ, right? For MAGY, you trade cover calls on the Magnificent Seven. The fit here is good tactical tool if you are bullish on big tech but want to monetize high valuations, right? Plus 28% total return. KQQQ, you buy active tech giants. Your issue here, your issue is high expense ratio at 1.08%. You pay more for a middle ground yield around 17%. So Just trade-offs, right? All great, in my opinion, all great ETF. It just depends on your strategy and what your mindset is. And the picture is not loading again. Oh my lord. The zero date time expiration revolution, TDAQ, TDAQ, zero date to expiration. The innovation here is TDAQ resets your cap every single day. The benefit mitigates overnight gap risk. Unlike monthly funds, you capture the full overnight move. The performance, you outperform the NASDAQ 100 benchmark by almost 11%. In late 2025. The risk here is intraday whipsaw. You lose on both sides in a V-shaped market day. So TDAQ is a great core satellite, right? So do you have it as diversification? I know I personally, I get a lot of heat for this too. I personally, won't make this a core just because of its strategy, right? So in a bull market, you would do fine, but in a choppy and or downtrend market, you're just gonna end up eating losses after losses after losses. So riding it back up will be a lot harder. All right, institutional cores. How can we forget about NEOs? NEOs always has to be mentioned in every single video because of how well they're performing. SPYI and QQI, right? The gold standard for your taxable account. They give you your tax alpha gains taxed at 60% long term, 40% short term via Section 1256. The benefit here is a 12% yield. Here puts more money in your pocket than a 16% from standard funds because of the tax benefits. The strategy they use is call spreads. You participate in upside rallies, avoiding the hard cap. Institutional cores, Goldman and BlackRock, right? GPIX and GPIQ from Goldman Sachs. Your cost is the lowest fee of all cover call ETFs at 0.29%. They use a strategy of dynamic overwrite. They cover less in a bull market, so you cover more growth. Then we have BALI from BlackRock. They have both active defense, which the strategy is quantitative stock selection, and partial overwrite. They sell calls only on a portion, preserving your upside. Then we have QDVO, right? Amplified CWP. They are the sniper, actively selecting 20 to 40 growth stock. They are growth first and then income, right? They use a tactical overlay. They only write calls when your stocks are overextended. So this one here, you have to believe in the managers. You have to believe in the picks they have, because if they pick the wrong stock, then you are screwed. All right, destructive rock, right? The smoking gun. We have constructive rock, which is benign, tax efficient. Who has the constructive rock? SPYI, QQI, GPIX, right? And those are just three. It doesn't mean the rest has none. I'm just listing three. The proof, their NAV has risen year to date. They use Section 1256. This is a tax feature, not a flaw. Destructive rock, right? Capital erosion. The smoking gun, well, I'm gonna have to say TSII payout rate was 66.8%. TSII real income, which is the SEC yield, was 4.38%. The math of destruction behind this is that about 62% gap comes from the NAV. If Tesla trades flat at 0%, your investment value drops by 62% in 1 year, right? That is not income, that is liquidation. As of right now, this is just a warning sign. I'm not saying it's happening, right? Please listen to me carefully. I'm saying if Tesla trades flat or ends up being which is a choppy market, right? Then what happens to TSII? All right, the destructive rock test. This is my verdict. TSII. My evidence is that 100% estimated rock, 66% yield versus a 4% SEC yield. My verdict here is high risk. You're getting your principal back. NVII, 100% estimated rock, 107% yield versus a 4.5% SEC yield. My verdict here is high risk. I'm going to say unsustainable if NVIDIA goes flat. Once it goes flat, once people are saying, okay, at some point, NVIDIA has to be like, well, we aren't really profitable right now, or right now our profits are going down or it's flat, then what happens, right? Then the moment the market sentiment changes, so will your payout. That payout is no longer going to be sustainable. HOOW, 100% estimated rock, 33% payout, dropped in 1 week. My warning, struggling to pay you organically. Then we have BLOX. I believe as of right now, it has a negative SEC yield at 0.72%. You guys could probably fact check me. I'm pretty sure when I checked before putting this video out, it was 0.72%. Again, depending on the market and the payouts. My verdict here right now, it is kind of destructive. Your NAV is down despite high yield. The NAV could be up right now. I don't know. Like I'm saying, it could be up. So if it's up, then we have to keep an eye on it. It is on my watch list. Constructive rock, right? SPYI. Constructive rock via section 1256. My verdict here, save you taxes, is actually doing what it's supposed to do, right? It's actually positive. They're actually making profit. We have historical data to go look back onto this. So right now they're doing well. SPYI from NEOS. Again, I always praise NEOS. I know I'm not being biased here. NEOS has just been doing good. I think that's undisputed as of right now. NEOS has just been dominating. All right, volatility drag, the math, your unsolvable trilemma, right? You cannot simultaneously maximize leverage, income, and NAV preservation all the time. These three cannot be done at the same time. Your scenario, for example, if your fund drops 12.5% on a 10% stock drop, the recovery is capped by cover calls, you suffer permanent underperformance. This is a volatility tax you pay. So for those who are investing in income or cover call ETFs that uses leverage, right? And they're trying to pay, and they pay you, and they're trying to quote unquote do NAV preservations. Almost not gonna guarantee not gonna happen in the long run. Short term, sure, because you have the short burst of people inflows and the market going up. But over the long course, not gonna happen. You cannot do it all three. It's mathematically almost impossible to. All right, my motto here for those who are new, welcome to the channel. Right, I've always tried to create a slide for the newbies. Right, this is the conservative income for the newbies. Right, so 80% of your portfolio is core. For example, GPIX, GPIQ, SPYI, BALI. And then you have 20% as your satellite, even though QDVO I wouldn't consider a satellite, but it's a satellite because it's growth first and then income, right? QDVO, dividend growth, right? So, what this would be a satellite considered for the, yes, it is a satellite considered for the newbies. These are extremely, in my opinion, extremely safe picks at the core and satellite. For someone who's starting out, I would say if you have less than a year in this kind of cover call income investing or investing in general, I recommend a very, very conservative approach. Right, if you can't afford the melting ice cubes risk, stick to this. The goal here is to preserve NAV and smooth income. This is what you should be targeting, anywhere from 5 to 8% target yield, maybe pushing 10. That's fine too. 10% is great. I would still consider that conservative. All right, the moderate yield, right? For the semi-seasoned investors, it seems like for the most part, a lot of people who leave the comments and watch the videos, I think you guys would fit this more. It seems like you guys know what the hell you guys are doing, and just from the comments you guys leave, it really makes me feel like you are a little bit more seasoned. So I would say target your yield in 10 to 15. This is for people who have at least I would say anywhere a minimum 2 or 3 years of investing at the minimum. Just semi-seasoned here. Your core would be 60%, your satellite would be 30%, and then your tactical would be 10%. For when you need cash flow but don't want to miss out on the tech bull market, right? So you guys know what you're doing. Right, the 60% core is obviously SPYI, QQI, QDVO. Your 30% is your satellite, MAGY, TDAQ, and then your 10% tactical. You can choose CHPY or another higher risk. And this is for the aggressive income. You know what you're doing. This is for people who absolutely like these are the traders, right? They have 5, 7, 10 plus years of investing, trading, playing around, like they know what they're doing with their money. They've lost 10, 20, 30, 40 grand and they've made it back. I would say this is the portfolio for you, right? You're 50% into speculative, right? TSII, NVII, HOOW, 30% ultra high yield, blocks, darky, and then 20% core as your anchor, just in case you don't blow up your entire portfolio. But for the most part, that 80%, I mean, you know what you're doing, right? These are trading in and out, in and out, in and out, getting in, out, and kind of making your money that way, right? Only if you can actively monitor NAV, you're harvesting volatility, not compounding wealth. So these are for the active traders, the pro traders. I would say your target yield is 20 to 50%. And then my verdict, right? For the adults in the room, go and choose, the adults in the room. These are the big institutions. These are the ones that are going to be like, I want to say, the more grounded, right? SPYI, BALI, GPIX, QQI, right? The fact is they use Section 1256, very tax efficient. And another fact, the NAV has been stable or growing year to date, right? A boring 12% yield that grows is infinitely superior to an exciting 60% yield that consumes itself. I hope that makes sense. For those who are new and that doesn't make sense, leave in the comments and I'll explain it to you. Right? For the wealth consumers, TSII, NVII, CHPY. The fact is that CHPY reported a 99% return of capital on December 2nd, 2025. Another fact is TSII payout was 66%. Rate exceeded real income 4% sec yield by over 60%. This gap is your principal, right? Do not marry these funds. Use them only for short-term volatility harvesting. That's what I believe. I'm probably gonna get a lot of heat for it. CHPY might be a great growth stock, but as of right now, I would say get into CHPY if you know what you're doing. They seem to be a very volatile, even though they hold great stocks. And I've looked into CHPY and I really thought about adding it, but I think I have enough of the Mag 7. I hold a lot of Qs myself and probably buying a lot more Qs by the start of 2026 or mid 2026. I'll start buying a lot more Qs. But CHPY, I don't know. Even if they hold the CHPY, I nicknamed CHPY Mag 10 because they hold the Mag 7 and 3 other tech stock plus a little bit more of everything else. But if you're gonna get into the Mag 7, why not get something a little bit more stable? CHPY is kind of a little too volatile for me. Is hence why I kind of put them for you know what you're doing, and kind of for the seasoned investors. They're a little too up and down swing for me. But for those who own it, I hope it works out for you. I don't have any, and for those leaving comments saying I'm biased, I'm not biased, right? I just don't want to have to wake up 3, 4, 5, 6 a.m. or check my portfolio every day. This channel is all about holding long-term growth, right? So, I hope CHPY becomes a long-term growth because I'll end up buying it and I'll make a video saying, and I'll give you, I'll even tag you guys. These guys said to buy it. I didn't buy it. Now look at it. I was wrong. You guys were right. All right. Thanks for watching. Subscribe, comment, like. I really appreciate all you guys giving me the support, leaving the comments. And I will be doing deep dive requests. If you guys want a deep dive request for my opinion, that means a lot to me. That means my opinion matters. And that puts a smile on my face. So I appreciate you guys requesting some videos. So that'll be the next one, or the next maybe few days. I'll try to do some deep dives. But thanks for watching, guys. Catch you guys on the next. Stay tuned.